Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you.
Mike, we just had the World Climate Conference and, of course, China, Russia, and India not really wanting to take part in anything. And that's a third of the world's population. But them aside, people think electronic vehicles are the way to go. And what's happening with EV stocks?
Well, they're going to the moon. I mean, it's pretty crazy. I've been trading the market since the 1990s, and really what's happening with these stocks, it reminds me of some of the internet stocks back in those days, because there were several high-profile internet stocks that made no money at all, and they went straight up, and then a few years later they went to zero. But, you know, over the past couple of years, Tesla has been one of the most popular stocks for people to trade, one of the most widely owned stocks among small American investors. And the critics of it, or skeptics of stock market valuations, have seen it as a poster boy for overvalued stocks and hype. In fact, Elon Musk has gotten in trouble multiple times with the Securities Exchange Commission over tweets he made concerning Tesla in the past. But I got to say, some of the other stocks that are going up in recent weeks are, you know, they make that Tesla story look like a solid investment. For example, there's a company that IPO'd last week called Rivian Automotive. It's the biggest IPO of this year, and it's trading with a market cap of over $120 billion, while it doesn't make a penny in revenue. It has no revenue at all. I mean, my website, small business operation, makes more profit and more revenue than this thing does, but it's the trade of the week. It opened up around 100. It's trading at 170, but that $120 billion market cap is a larger valuation than General Motors and Ford combined. Now, another one of these stocks is trading with a 90 billion market cap, and it only made 232,000 revenue in the last quarter and lost $1 billion. So to me, these are crazy companies, crazy stocks, and they put everything else perhaps to shame. I mean, even cryptocurrencies perhaps are better investments than stocks like this when you look at valuations. But these type of trades, again, it's very similar to the 1990s, because we had an internet stock bubble in that decade, which really was the result of the Federal Reserve lowering rates and keeping them too low for too long. So people were speculating with money that they may have previously had put into bonds or safer investments. Now, the Fed in the 90s, they lowered rates in 1998 as a result of a hedge fund crisis that threatened to cause turmoil in the financial markets. Now, this time, 2020, they took rates down to zero, started the QE bond buying program, and we had a tremendous rally in the markets last year that's carried over into this year. There have been a few speed bumps on the way. But again, when you have rates at zero, People can't make money on their CDs. They can't make money in the bond market. And as a result, people that do have lots of money, some of them are feeling they must speculate in the stock market, and therefore some of these people are buying anything that goes up or what they think is going up the most. I mean, there's alternatives to doing that. You could do what I believe is a safer alternative. That's what I'm doing. I have core positions in gold, silver, and commodities. And, they've gone up too, not as much as, this Lucid thing was $10 in January. Now it's 55. But, I believe that things that, I believe companies that pay dividends and make profits are better long-term investments.
Generation Zers or Zetters in Canada, they don't believe in getting rich the old-fashioned way, which is go to college, get a good degree in something like medicine or engineering, work hard all your life and save up. Instead, they're living in their parents' basement, trading on Robinhood, and so far they've been successful. How long do you think they're going to be successful, and will they have much money once the dust clears?
Well, I believe that phenomenon requires more and more people entering the market to trade. It's like a pyramid scheme. And once you run out of new players, I think it's going to run into trouble. Now, the Robinhood company itself, they have they have something like 20 million college students. And I think I mentioned on your show last time, or sometime in recent weeks at least, that they started a new promotion where they're trying to promote the college students and let them open up accounts with no money at all. They don't have to make a deposit, and Robinhood will deposit a small amount of money for them. So they're self-funding their account. Now, that's a marketing campaign that can bring new people into the markets with almost no money. These people don't have any money, but, maybe that can help fuel this a little further. But all that said, I've just read yesterday that they started a whole new marketing initiative, which is something I've never heard of before. And I got to quote it to you because it's pretty crazy. But it's an alliance with Burger King. They're teaming up with the fast food company Burger King. Burger King has a special rewarding perks program through an app. You got to have the Burger King app to be a part of this royalty program. But if you have the app, they are offering you a prize when you buy burgers through the app to win crypto. If you spend $5 at Burger King through the app, you have a chance to win cryptocurrencies. And if you get the winning, you win it through a Robinhood account. So you're able to open up a new Robinhood account funded with these crypto coins. Now, what's funny about it is this is the marketing explanation. I'm going to quote directly from the head of the vice president of digital guest experience for Burger King North America. This is what she told USA Today. The fast food chain is, quote, offering crypto in a way that's accessible and digestible, literally and figuratively, through our food. So this is where we are now in the markets to try to find new customers to get into what I think is a financial pyramid of trading crazy stocks, crazy cryptocurrencies, and whatnot. So how long can this last? I guess as long as they keep making campaigns like this, and as long as interest rates still stay at zero. The real big danger will be at some point, interest rates will go up, and they'll go up enough. I don't know what that level is, but at some point, if rates do go up, it will bust the bubble. That's what happened in 2000. Rates, when the Fed started to raise rates, everything collapsed. Eventually, the internet bubble popped in 2008. when the internet bubble busted, there was a 3-year bear market. The Fed took rates back down close to zero again. That helped stir a bubble in real estate. And then when they raised rates back up, that bubble ended and the air sucked out of the real estate market. That helped eventually cause the crash of 2008 in the banking system. Then they lowered rates again, and we were in this weird zombie environment for 10 years that culminated in what happened in 2020 when they took rates back down to zero. So we're in this weird bubble phase. I mean, I've seen warning signs of speed bumps that could lead to an eventual top, but that top hasn't happened yet. The last warning was in the summer. The internals of the market started to fade back down, meaning more stocks inside the stock market began to decline than go up. That is a warning sign of an eventual top. It's not a sign that the top's the end, but that it will come at some point within usually 6 to 12 months. But the ultimate trigger will be higher rates. Historically, it's taken 3 rate hikes for the stock market to take a stumble, but as it stands now in the Fed fund futures market, there's no expectation of an interest rate hike in the United States until June of next year, and then they're looking at a possibility of 3 to 4 rate hikes, let's say from June to January next year. So we'll just have to see, but at the moment, I would say the bulls do have the wind on their sails, so to speak, and it's probably going to stay that way at least into next summer.
Now, agricultural commodities going up, coffee going up. Is there any end in sight for regular consumer goods? Because some people pointed out some items have come down, but your day-to-day things that you're going to have to use every day, unless you can give up your coffee, which I think is a worse addiction than tobacco, frankly. Not in terms of it being bad for you, but just being hard to give up.
I agree with that.
So with this kind of thing, is that what investors should be looking for, is for those commodities, agricultural commodities, to continue to be hot even if other things slow down?
I personally believe so, because I think, I do think we're in a sort of similar, I mean, nothing's exactly the same, but I think inflation isn't a short-term trend, but a secular trend that only is just starting. So if you look at agriculture commodities, they had been in a bear market for 10 years, over 10 years really, that ended last year in the spring when coincidentally energy prices went in the futures market went negative, which is something that never happened before. So those were secular bottoms in the commodity market. Secular trends, they last for years, a decade or longer. So the way I see it, any pause in commodities is a buying opportunity. But we now are seeing inflation jump up to 6% in the United States. That's the official CPI number. I'm just going to go by that. I mean, people can argue it's higher, but if you just take the official number, 6%, 6.1, the headlines were, this is the highest level since 1990. Well, yeah, but the funny thing about that is if you look at what happened in 1990, inflation was going up slowly, and that was the peak. And now, if you look at long-term inflationary trends, this doesn't look like the peak, but a breakout of a decade of low inflation. Now we're breaking out of that and starting a big inflationary trend. And I think the comparison is more to 1973, because if you look at that time period, the rate of inflation was basically less than 4% every year, with about one exception, but from 1950 or 52 to 1973, and then boom, it went above 6%, and the rest of that 70s was defined by high inflation. So I see this as a similarity to that, and also in the 1970s, there was a bear market in the stock market in terms of price in the middle of that decade. After the Federal Reserve raised rates a couple times, I think it was in 1975, the stock market took a hit. But after that drop in the stock market, inflation just kept going on and on and on. Commodities were the best trade of that decade. And all the stock market did was make it back up to the previous high and then do nothing and lose value in terms of inflationary, of inflation. So I think that's probably what's going to happen in the years to come. At some point, there will be higher rates. It will cause a temporary dip in inflation and a big dump in the stock market. But once that process happens, I'd expect the stock market to bounce back, but inflation just to get even stronger. Because, if you raise rates, let's say they raise rates 8 times, let's say, and then they got to lower them back down again, that's just going to fuel more and more inflation. So I think I think those are the big investment trends to come. And the thing is, what I also feel about investments that are linked to inflation, let's say energy stocks, they pay good dividends, they got earnings, and even if all these things don't play out like I'm saying, and there's not going to be a stock market decline and all, it's not like the 70s. Well, these are still good investments anyway. So stick with good companies linked to commodities or energy, mining that do pay good dividends, and I think it's going to pay off. And at the moment, I would say that there's still good opportunity in mining stocks because they dipped down from June to October and have bounced back up, but they haven't been going up as much as energy stocks and some of these other commodity related stocks. So I think they at this moment do have overall good entry points, and the juniors in particular, for the most part, you haven't really caught a giant bid yet, but if gold continues to go up, and I think it will, at some point that'll happen with them. They just tend to lag at first during a gold rally.
We'll have more with Mike Swanson right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, so many companies have announced record earnings, and their plans for that money is to buy back stocks. Why aren't they paying dividends or just saving that cash for the eventual downturn in the market when they'll need that money, or are they just relying on government bailouts again?
Well, it's probably the latter, and also from the perspective of the CEO and the board of directors. Typically, what'll happen is they'll use their stock options to sell their own shares as the company does the buyback. So it also tends to be a way for them to enrich themselves. And I can go back and remember this happening in the years of the past, where there'd be a company that the CEO sells $100 million worth of stock, and the company's buying back a similar amount. So I easily think stuff like that is going on, or we'll start up even more in the months to come.
Some have expressed the opinion there's so much money on the sidelines. If the Fed does taper, this private money will just fill the gap and the stock market will continue to boom. What's your feeling on that?
Well, I think I don't really, the phrase money on the sidelines is one I'm hesitant to use myself, but I do think overall that notion's probably correct. This taper thing that the Fed started this month to month by month pare down this bond buying program to end it. It's happening so slowly that I don't think it's really a hawkish policy. And also, interest rates are zero. So I don't think it is taking away the dovish tilt in the financial markets at all. So I think that's why it hasn't really had an adverse effect on things. I think the biggest threat to the market is, frankly, higher inflation. The Fed keeps predicting that it's going to go away or it doesn't matter, and they've been proven wrong on that. And I think at some point that's going to be the ultimate problem for most of the stock market.
Well, when the Fed was created on Jekyll Island back in the early 1900s, the whole idea of the Fed was to stop recessions and depressions, and our market historian Bob Hoy has pointed out since the Fed was created, we've had at least 18 recessions. They're not very good at their job.
No, and why is that? I think it's two reasons. One, politics. I mean, they say they're outside the political system, but it doesn't matter. They have politics they have to face, and they don't want to create controversy or adverse attention on themselves. So I think that has caused them to be too dovish over the decades, which has built in all these imbalances. I think Alan Greenspan, I spoke in the 1990s, I think he's way too dovish, and he could have been a little bit more hawkish for certain, and he failed to do that, probably in fear of, if I cause a bear market or something, then people are going to get mad, so I won't do it. And then he doesn't do it, and he makes the imbalances worse. So when bad things do happen, it's worse than it ever should have been. And I think that's one of the problems of the Federal Reserve that's led to where we are now and how things are likely to get worse at some point. And then the second thing is simply that I do think there's a libertarian argument to be made that the idea that a group of individuals have the ability to set the interest rate or figure out what monetary policy should be is just unrealistic. I mean, no one is smart enough to be able to tell what the exact rate of interest should be. And by taking, interest rates down to zero, they ruin the market mechanism. So they made what is a built-in problem in the Fed, setting the perfect rate of interest. It's an impossibility. They've basically made it so that problem is turned into what will eventually be a disaster. And a couple of years ago, I was looking at Federal Reserve transcripts of past meetings, and out of curiosity, I went and took a look to see what they said when Nixon took the U.S. dollar off the Bretton Woods agreement. And in that meeting, they were talking like it was a temporary thing, and they thought they'd just get back on Bretton Woods in a couple of weeks. Well, obviously, that did not happen. And I point that out as proof that these people are not omniscient, and they may not really know what they're really doing. So I don't think they're as powerful as people think. I think it's the complete opposite. I think they're like blind men driving a car, and everything's okay for the passengers until that car hits a wall. I think that's a better metaphor for the Fed than to think these guys are just manipulating everything and in control of everything and so forth. When I see Jerome Powell speak, I see a guy trying to fool the people and fool himself, with his crazy predictions that he's made over the past 12 months, that inflation would come and just vanish overnight. He was saying that in January, inflation's going to come in the spring and just go away. Transitory. It was all nonsense, as we all know now, with their official rate of 6% annualized CPI. So this morning, I saw a headline where some other Fed official was saying they don't need to raise interest rates because they don't need to preempt inflation, making it sound like inflation's not even here. It's just madness. But I think they fool themselves because they're kind of trapped and they don't really have any good solutions. And the legacy of decades of mistaken policies and that have led us to where we are now. Everything's okay. And I mean, it's not okay when you go to the grocery store, but it's okay when you look at your Robinhood account, your crypto account, and really for just about everyone in the markets. Commodities are going up. No one's really suffering in the financial market. So that's okay, but it's not really okay because the reason for that is not a good one.
Mike, thank you so much for chatting with us.
Thank you. Good to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike, you can send them to info@HowStreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.